Opening a trading screen is a jarring experience. You are immediately hit with a wall of flashing red and green numbers, erratic lines, and shifting data points that often feel impossible to decode. These digital charts represent a continuous, living auction. This space serves as a venue for price discovery, where participants negotiate the value of a security in real time. Historically, this auction happened face-to-face. Buyers and sellers stood on crowded trading floors, shouting and haggling to figure out exactly what an asset was worth at any given second. Every price movement resulted from a real transaction between two people. While that negotiation has largely moved to global electronic networks, the mechanism remains the same. You are observing participants negotiating value in a digital arena. To make this system function, you only need three components: an asset to trade, a currency, and a critical mass of participants. Without that third element, the asset is illiquid. If the participants vanish and the room goes quiet, you no longer have a market. You simply have an object on a wall. Any value you assign to it becomes entirely subjective. Despite the millisecond speed of modern digital trading, the underlying system is identical to an ancient bazaar, designed to transfer ownership as efficiently as possible. Price action is driven by two specific numbers. The bid is the highest price a buyer is currently willing to pay. The ask is the lowest price a seller is willing to accept. The gap between these numbers is the spread, the literal friction of the market. No trade occurs until someone yields. Like a tug-of-war, price only moves when a participant crosses the spread to meet the other side. To understand who is winning that tug-of-war, we have to look at the order book. This is the real-time ledger of every pending buy and sell order currently waiting in the market. You can visualize this ledger as a physical space. Price moves exclusively because the supply at a specific level was entirely consumed by aggressive market participants. Mathematical indicators and chart patterns are secondary reflections of this mechanical reality. This creates a vacuum effect. Aggressive capital sucks up liquidity and moves through empty space until it hits a thicker wall of sellers. The density of those passive orders determines the market's liquidity. This dictates how easily you can enter or exit a position without shifting the price. A highly liquid market is like an ocean. You can drop a significant order into the water, and the overall level doesn't change, because there is always a counterparty ready to absorb the trade. An illiquid market is a puddle. A single, relatively small order can cause a violent splash, eating through multiple price levels just to get filled. This lack of liquidity creates the risk of gapping. If you attempt to sell a position during a period of low liquidity, you may find that nobody is there to take the other side of your trade. A gap is a literal hole in the order book. The price must freefall, skipping over multiple levels until it finds the next participant willing to buy. High volatility often indicates a total lack of participants. Without resting orders to absorb trades, every isolated order throws the price around. Massive liquidity provides a smoothing effect and structural safety, while low liquidity creates an environment that is unreliable and expensive to trade. Every trade requires a counterparty on the other side of a zero-sum bet. When you buy because you expect a rally, your counterparty is selling because they expect a decline. Institutional whales face a significant execution problem. They cannot acquire massive positions the way a retail trader can. If a whale tried to buy $500 million of stock all at once, they would bulldoze through every level of the order book, driving the price up against themselves and ruining their own entry. To avoid this, they use stealth tactics. They hide their true size and quietly hunt for pockets of panic selling, absorbing that aggressive supply with their own passive buy orders. The complex patterns forming on a price chart represent the literal footprint of large capital maneuvering within the constraints of the order book. Human emotion saturates this mechanical system. Positive news turns buyers aggressive, while a grim outlook causes sellers to hit the bid at any price to escape. During a market panic, buyers often delete their passive orders entirely, leaving a hollow order book. The price enters a free fall, dropping until it reaches a level where a new group of buyers is willing to risk capital and provide a sturdy floor. Regardless of the emotion involved, the market's execution is always the same. It is blindly searching for the next level of liquidity. Effective trading requires you to stop using charts to predict the future and start observing where participants are trapped, aggressive, or absent. You see these same mechanics at a local estate sale. If you realize 3 other people want the same antique lamp, your internal bid skyrockets. The urgency to cross the spread and pay the asking price becomes immediate. The global financial market is simply that same human urgency, quantified and scaled up to millions of decisions per second via the order book.